Financial Quarterback. We're live on YouTube, Spotify, iHeartRadio, New York's WOR. And we have a man who called the 2022 market crash when I interviewed many people from Lacey Hunt to Jeff Snyder to, everybody, and they didn't quite get the call right into the timing. They said trauma was on the horizon, but this guy called it almost to the day, if not within, I want to say a month, few weeks. Early January 2022, I was getting all these emails about this guy, Greg Diamond, that I never heard of before. And he was using technical analysis, and I'll share with you kind of my background with TA. But for those who've not heard of your work, you are the editor of the 10 Stock Trader, a trading service based on technical analysis for Stansberry Research. But describe your background in finance.
Sure. I actually got started with a hedge fund in Baltimore called Campbell Company. Black box, all based on price and time, and really no fundamental analysis whatsoever. So that's kind of where, I started, and, I just kind of followed that path for the rest of my career and used, as you mentioned, technical analysis, price, time, long-term cycles, short-term cycles, to manage my investments, to manage my trading. And that's kind of where my background began and where I am now.
And who would you say are your biggest influences in technical analysis?
Without question, Paul Tudor Jones. My first boss at Campbell Company traded with and under Paul Tudor Jones. And if you've read anything about Paul Tudor Jones, especially in Market Wizards, he talks about how important price is and time, and how price and time actually lead, and then you see the fundamentals follow. It's a different concept than probably most of your listeners, especially if you just, if you watch CNBC and, or if you have your CFA and all you hear about is fundamentals, earnings, and those are all important. I'm not saying they're not, but what I learned, especially, not through Paul Tudor Jones, but just learning from my boss who worked with him, is understanding how important price action is, how important time is. That helps you manage risk. That helps you understand what's possible. It also, probably the most important thing, is it keeps me unbiased. I'm not a perma bear. I'm not a perma bull, regardless of the market. I want to be open to what is possible. And by following technical analysis, it allows me to do that.
We, on our staff, my SEC RIA, we have a time price guy. All he does is charting. He talks about Gann, triangles, all that stuff. I believe he even worked with Paul Tudor Jones. His name is Stan Harley, and he's big in the world of TA. And I started reading, your newsletters or the sales letter of your digest. I was like, oh, this guy might know some stuff, because you were sounding a lot like Stan Harley, who we've had on the show before. But a lot of people will use TA and they'll come to completely, or technical analysis as it's referred to, and they'll come to completely different conclusions. What do you make of that? I could name 10 different technical analysts. They have 10 different opinions.
Sure. I think the biggest, I kind of just mentioned it in terms of bias. Especially getting on Twitter and you see, there's always so much negativity, and, the world's going to end, the dollar's going to collapse, stock's going to go to zero, gold's going to go to 1 million, or the opposite, Bitcoin's going to go to 1 million. So, you can always have these different, opinions about what's going to happen, but you can say the same thing about fundamental analysis as well. Forward earnings are X, therefore, the S&P is going to do this, or earnings on a specific stock are this relative to the last 5 or 10 years. So therefore, the stock's going to do this. At the end of the day, what I love about technical analysis is it increases my probability of not only what is possible when I'm right, but also it tells me exactly where I'm wrong. And that helps me. It's both a risk management system, and a trading system in terms of, hey, this is what is possible. I'm going to buy here, and then here's my stop based on technical analysis, based on those different scenarios. and then I go from there. So when you have 10 different opinions on what the S&P 500 is going to do, they're always going to be there. The question is, where are you wrong, where are you right? And that's what I love about technical analysis, is that it gives me that framework to manage risk and to get directional.
What books, if somebody's new to technical analysis, what would you tell them? Where would you tell them to start out? What books, and then what signals?
Number one, hands down, is Market Wizards, the original Market Wizards. I mentioned Paul Tudor Jones. He's in that book, famous hedge fund trader. I would say Robert Precher's Elliott Wave Principle. That is going to give you an insight into Elliott Wave theory, which again is risk management and the trading system wrapped into one. Those are going to give you the signals just based on price. And then, I would say the third one is anything you can get your hands on related to WD Gann. And it is a long process of trying to understand Gann, all the methods that he used. Luckily, once you start to grasp Gann, there's some software programs out there now that are actually really good at utilizing what Gann did in the software. And so those are the three books that I would recommend. And then, within that, in terms of the signals that you asked for, you're going to learn the dynamics of Elliott Wave and understanding, you look at a price chart, okay, it starts to make sense. The chaos becomes a method. That's what Elliott Wave is going to teach you in terms of price and signals. Okay, this is where I buy, this is where I sell. And those are probably the best signals. And then, you'll filter in indicators, how to understand which different waves relate to those indicators, and it just gives you a higher probability of what's possible. Again, I mentioned that. And then Gann is all about time. And then those are the three tenets of technical analysis that I like to use in my trading service.
What do you, so you're an Elliott Wave guy?
Sure, absolutely.
We had Elliott Wave guys on the radio show a lot, like 7-8 years ago. Guy was too confusing, so he lost a lot of the listeners. I would go to Timer Digest and see, who was the best. I think Timer Digest is now no more, but they would kind of have different guys give their signals, and they would. But what I did find is some of the people use the signals to justify their bearish or bullish bias. How do you protect yourself from that?
Managing your risk. Again, it's really simple in the fact that, if you study Elliott Wave, or even if you don't use Elliott Wave, whatever your bias is, we're all wrong all the time. And so the question is, are you going to be comfortable with being wrong, and where are you going to be wrong, and just admit that you are wrong with getting out, and then, starting over again, or saying, okay, I was wrong on this one. Where am I going to get back in? Or am I going to flip from long to short, or vice versa? So, that's kind of where that's my mental mindset in terms of, how I utilize this stuff.
Yeah. Now, how did you get last year's call right? And what are you thinking about this year?
So last year 2022 was based upon mainly a lot of Gann cycle analysis. There's also, there's, different tops and bottom sequences that occur throughout market cycles. So, there's a 16, 18, and 20-year panic cycle. And there's a 7-year cycle for long-term tops and long-term bonds, or long-term tops and bottoms. So 2022 was interesting because, number one, it tracked the 7-year cycle top. So take 2022 and then subtract 7. You go back to 2015. That was
now you go
China,
top to top. So do you mean December 21, 7 years back, or no?
Yeah, you could do that as well, but it's not.
Do you
January
go peak to peak, or do you go trow to trow? The valley to valley,
peak to peak,
peak to peak.
Right. So 2022 minus 7 is the 2015. That's when you saw China top out. It still hasn't made a new high above that high, but the S&P topped out. And here's the other thing: everyone who talks Gann, or at least a little bit familiar with it, every time you say something about a cycle, it's like, oh, well, it's going to be the end of the world. It's going to be 1987 all over again, or it's going to be, the bottom in 2009. It's not necessarily the case. With Gann analysis, especially time, it means a inflection point or an inflection point. Sorry. So it doesn't mean that it's going to, be the biggest boom or the biggest bust. It simply means this is a really good trading opportunity. This is an inflection point within the market that you need to pay attention to. So, 2015, then you take 7 minus that, and you go back to the great financial crisis. So you can see how this process unfolds. So that was probably the biggest component to calling the 22 bear market.
Yeah, and it seems easy now, but I mean, I read stuff every day, and even in the cycles community, January faked people out. Was it 2023? Was it 2022? Was it, they were all kind of struggling to discern the exact top, whether it was November, December, January, but you got that call right. What do you think of now? Like, do you think the October low of 2022 sort of was the low, or will we have our cycles guy is saying, hey, maybe June retest the low and then kind of put on your dance's shoes, be bullish then? I think I read something that you said maybe March of this year was the low, kind of the Silicon Valley Bank moment, which in hindsight would be a good low because you have, banks like Schwab losing 30-40% of their value, good quality companies. What say you?
If you look at, there were a lot of stocks that bottomed out in October. JP Morgan, for instance, that's one of the stocks back in October that I said, I think this is the bottom. It doesn't mean that we won't see new bottoms, heading into early 2023. And that's exactly what we saw. So, the NASDAQ didn't make a new low below October, but the banks did. Not all banks. Obviously, SVB went, bust. And then you saw the regional banking ETF, KRE, that hit new lows, XLF. So that's where price divergence, technical analysis, understanding, hey, look, this sector or this stock made new lows while, JP Morgan didn't, semiconductors didn't, technology stocks didn't. So that combined with overseas markets, look at Europe. Europe, didn't even budge. It didn't even matter what was happening with the regional banks here. So, is that contagion? Is it not? I don't think it is contagion. Otherwise, a lot of people like to compare this to 2008, 2009. And I just don't see the comparison because if you follow the price action in 2008, everything was going down. It was complete contagion everywhere. But if you go back to March when SVB failed, look at what happened with semiconductor stocks. It was just a blip on the radar. If you were just looking at price and not understanding, never not reading the news, you'd never know that the banks were failing because the stock just kept, there's a little bit of a drop and then it just kept rallying again. So for me, back to your original question, I'm quite bullish. It doesn't mean that we can't see more volatility. That's probably going to be certain given the Fed, given banks, given inflation. So, there's always going to be that wall of worry. And I wrote about this to subscribers last week or earlier this week, actually, that bull markets climb a wall of worry. And I think we're in the middle of that worry, which is why I think we're going to rally. So I'm looking for some opportunities to buy because, especially in the NASDAQ, that March 13th low, I talked earlier about, understanding where you're wrong. As long as that March 13th low holds, I'm buying. And I think that is a bullish setup. You look at a price chart like JP Morgan, it's an unbelievably bullish setup. So, that I'm bullish based on those different factors. And, the great thing is I understand exactly where I'll be wrong.
So where do you get, so where do you get your confidence from on this bullish setup?
The fact that everyone's so bearish. That's a big reason. I'm relatively new to Twitter. I like it for some things. I don't like it for a lot of things. But one of the things that I've found anyway is the extreme negative sentiment, and you get to really find out who the perma bears are by just kind of scanning through, and that is where you can see that relative in the price action. So you have this big dip. Look, just this morning, NASDAQ was down 1%. Everybody comes in and starts buying, and now it's, almost back to flat. So that type of price action confirms, hey, look, everyone's looking to short this. And a lot of people, I think I saw that hedge funds are net short the most in a 12-year period or 12-year history. So,
Wow.
if everyone's short and and the price action isn't following through, I want to be long. And it's kind of that simple. But that's kind of where, and I go back to the price divergence I talked about. You look at JP Morgan, and it's a really strong price chart. You look at a stock like Caterpillar, it's a really strong price chart in terms of the setup and the bullish price action. So that's where I get my confidence. And again, I understand exactly where I'll be wrong, but I'm looking for the S&P to make an all-time new high this year. I think we can rally about 20%. NASDAQ could rally 30. So that's what I'm sticking with.
No, that's great. The one thing, can I share my screen, guys?
No, you can't.
Okay. Well, can we get it to be shared?
No, he's on Zoom.
I can't hear you, Josh.
Yeah. Why can't we
Oh, there you go. Okay.
share the screen? I mean, the whole thing is charts and graphs and all this stuff. One of the things that I don't know if you're familiar with the 40-day trading cycle.
Sure.
A lot of my guy, one of the guys I know internally, market looking very toppy here, below is a chart of the Dow depicting a 40-day trading trend change cycle, half the 80-day trading cycle I've so often referred to. Next recurrence is due ideally now, which was, I don't know, about April 14th. The next is due in the mid-June timeframe. So what I see, and the only reason that would kind of make me bearish is every top, I'm talking more about the Dow than the NASDAQ.
Okay.
Every top has been proceedingly lower since December of 21. And I have a chart of the Dow that I'm looking at, and it kind of goes up and then down, up and then down, up and then down. We're not breaking, 34,000 too much. We kind of hit it. It was 34.5-ish, 34.6 in November of last year. And, wouldn't you say that if there's no higher high yet, that's kind of a bearish setup, like a bearish diagonal?
This is how I would look at it. So the Dow bottomed in October and then had a huge rally and then topped out. I think the December 13th was the high. And then if you look at it, it had a dip earlier this year, January, late or more February, the low in March with the banks, and now it's starting to rally again. So to me, that is a huge Elliott wave 3 process in motion, meaning the Dow could reach well over 40,000 this year if I'm right about the S&P rallying 20%. So to your point, I understand where you mean, but this is also what I go back to and saying, okay, well, where would I be wrong? Where would you be right if that is the top? Well, that March swing low, and understanding the rules of Elliott wave is exactly where I would be wrong. So until that happens, and there's a big spread there, but I'd looking to buy dips on that.
Yeah, you wouldn't, but that's the hard thing with technical analysis. It doesn't necessarily tell you, because if you have a bullish technical guy, they'll say, okay, well, the October low and then the March low was way higher. We've confirmed that kind of was the low, the October low. So like the 7-year low was October. So then, bullish signal on. I just have a hard time. I find that sometimes cycles guys are right after the fact, not before. Does that make sense?
Yeah, of course it does. And I think this really goes back to what I said earlier in terms of, well, the cycle is going to be this or that. Okay. And what does it suggest? Well, I use it because it's going to improve my probability. There is no holy grail. Trust me, I've looked. It's just not there. So for me, it's like, okay, this is the bearish setup, or these are the bullish factors. These are the bearish factors.
So break that
And
down. What are the bullish factors now and what are the bearish factors?
bearish factors is the worry of inflation, the Fed, obviously regional banks. I would add commercial loans. Commercial real estate loans is also, a catalyst to be aware of in terms of, what is possible. But does the Fed have that under control? What if inflation cools off? And we've seen a little bit of that. What if it cools off? What if the Fed isn't as aggressive as they need to be, which is going to help the banks in return, especially in the regional banks? And then if everyone is still so focused from 2022 that this is going to be the next 2008, that sentiment, and I mentioned hedge funds being net short, the most in 12 years, guess what? The markets are going to do what hurts the most people. And if that many people are short and sentiment is that bad, the market's going to go up. So those are, the fundamental, or I should say macro catalysts, from the bullish and bearish scenarios.
Wrong. Meaning in this setup, what would be the indicators that would say, hey, it's really a bearish setup? I mean, besides the fundamental, fundamentally, I could see things breaking down. Everybody's expecting inflation's cooling, but then, later next year, that narrative, inflation stays at where it is or lowers ever so slightly. So, because you have the bearish setup is you have the 40-year, I don't know if you follow the 40-year bond cycle and interest rates. So you kind of interest rates looking like they're remaining persistently higher for longer, that although inflation cools, it may cool, whatever. What was it, 5, 6?
Yeah, I think 5%. I would say, so the 2020 low in interest rates in general is probably going to be a multi-generational low that's going to hold for a long, long time. So instead of...
I called that to the day.
Nice.
I didn't really help me other than I told all my clients and listeners and myself to refinance their mortgages and get 30-year at 2.25, but I could have traded that. And it was with Stan. He was insistent 2021 was the low in interest rates. I was like, no, it's now.
Yeah.
I'm getting a 30-year mortgage at 2.25. It's never going to be lower than this.
Yeah, that turned out to be a great call.
It wasn't really technical, other than I knew about the 40-year cycle, but that's scary. If we have if that 40-year cycle holds, although I think it's dubious. Stan has done little charts on it, and to be honest, he has data going back to like the Holland. He was with the study of the foundation of cycles and all those guys, and they have
Sure.
I think we have a totally different world and economy. So I think the 40-year cycle might be a little stretched to conform.
Yeah, we're not trading tulips.
Yeah. So it's no, but they go back to the debt of the colonial era.
Sure.
And they basically say, okay, well, every 40 years from the American Revolution, you had this 40-year cycle. But I think it's a different world. I mean, I'll give them it looked like a 40-year low, but I think the 7-year cycle is far more
well, for stocks,
noticeable.
I think that works really well. And interest rates are hard to forecast, and in terms of cycle analysis, at least my personal opinion is it's difficult to model. But you talked about the 40-year cycle. Look at take 2021 minus the 40 years, and that gets you back to when inflation peaked in the early 80s. So that's something that
and then
works.
he would go 40 years back. There was something going on in World War II. Sure. And then 40 years before that, it was like the 1890s. There was something going on. He has a stat for everything, this guy. But
right.
basically,
and there's also an 84-year cycle, which is a war cycle, which I'm not happy to report.
But that 90-year war cycle, some say it's 84, some say it's 93. Meaning, if you're just joining us, I'm with Greg Diamond, CMT of Stansberry Research, a man who called the 2022 crash almost to the day. And it was funny because I was getting these, the Stansberry things that cloud your mailbox. Sometimes you're like, yeah. What is this crap that I'm reading today? But Stansberry has some good people we've had on over the years. Steve Sugarwood's awesome. There's another guy, a couple guys that we've had on, and they're smart analysts. And when you were talking about Gann triangles, just got me, I want to read this guy because very few people will merge. You're really not so Elliott Wave as you're more like Elliott Wave combined with, you might say they're the same thing, but like Stan, who's my buddy, and he works for our firm, he's all like, time price. He would say cycles determine inflection points, not magnitude. That cycles don't tell you anything about whether we're going to have a 40% correction or 20% correction or 15% correction. And a lot of people will then use that to sell their newsletter. But so I kind of learned to respect your work. So it's always good to have good people in the cycle screening. But you're not so Elliott Wave. I mean, I guess that's an influence of yours, but do you do the A-B thing, or do you go A, B, C, D, E, or do you go 1, 2, 3, 4, 5?
So people get really caught up in the labeling, and the only thing I want to know is it a correction or is it an impulsive wave? Meaning, impulsive meaning big move up or big move down. And then, I get people all the time, well, that's not labeled right. It should be A, B, like it's ABC or the X, Y. Who cares? Is it a correction or is it not? That's all I really care about. I don't get so caught up in the minutia of, what the proper label is. I want to know, am I going to make money or am I not? And where am I right and where am I wrong? But to your earlier point about, Elliott Wave being an influencer, it absolutely is. But I tell my subscribers all the time that, never use anything in isolation. I don't care if you throw darts at a board or you're strictly 100% fundamental, just looking at earnings, debt, EBITDA, all that stuff, or you're technical like me. I'm never going to only use Elliott Wave in isolation. I'm never going to only use Gann in isolation. I'm never only going to use, RSI or MACD or any of the other indicators or candlesticks. Everything has to be, you have to have a system. And within my system, it's Gann, which is time. It's Elliott Wave, which is price. And then it's the indicators like RSI. And I like to use something called the composite index to formulate my plan and understand what is possible. And again, as I mentioned earlier, to improve the probabilities of whether we're going to see a bullish move or a bearish move.
I want to have a debate with you and Stan. Let's do it, right?
Let's go.
And it'll be fun. I think, but he would say the March low is June, and that's when he's going to get bullish. I think, and we could see significance. He said, what did he say? Okay, so he's looking good right now. He said April 14th was the high, short-term high. So we'll see if he's right. But
all right.
I want you guys to debate. Yeah, it would be a fun, because some cycles, guys, I don't really respect, but I respect you. I respect him. What other? So he says, I try to get info out of him. Like, what indicators do you look at? So he says kind of look at the big five. He's big into that. The big five indexes. He has his own kind of MACD RSI thing that he plots out. Are you in agreement that there's going to be another inflection point in June? You just think it's from a higher starting point?
I definitely agree with mid-June. That's on a Gann time factor, specific Gann time factor. That will, if I'm right, I think it just becomes a short-term top.
Okay.
So I'm looking for a breakout here in all the major indexes. We talked about the big five. I'm looking for a breakout here. Maybe the, well, sure it won't. The Russell 2000 small caps probably, they'll rally, but they'll probably make a lower high than, let's say, the Dow, S&P, or NASDAQ. But if I'm right about this breakout, June will be an inflection point. Again, it's not 1987 or 1929. It's just simply an inflection point within this longer bull run that I believe we've already started. We can debate that when
so you're both using the same theory, though, right? So you probably
I'm not sure what he. Yeah. So if there's, I don't know what specific cycle he's looking at.
He's big in the 40-day.
Okay, that's fine, but the 40-day doesn't repeat all the time. And again, You know, you have to look at it. So here's a really good tip for anyone interested in getting into GAN cycles, whatever it might be. Understand how an inflection point in terms of time happens relative to price. Meaning, if you're looking at June, okay, and it rallies into June, mid-June, whether that's the 40-day cycle like Stan's looking at or the GAN time factor that I'm looking at, I would expect that to be a high based on time and price. When people, you mention all the time and price. What does that mean? This is what it means. If you rally into one of these important inflection points regarding time and it's a high, guess what? It probably means you're going to have a top and you're going to have a correction. On the flip side, just like in March, if you have this low into an important time frame, like March 21st to March 25th is always usually a natural date that GAN talked about. Look what bottomed around then. JP Morgan bottomed around that time. You saw the Dow bottom. That was a low. That was a low into that time frame based upon price, and then you had this rally. So that's kind of where that's where I look at time.
No,
and
but
price.
that's what I'm saying. He's very similar to that. Because he was like, okay, March, buy, April, sell. It just seems like you have different conclusions on the time price. He's not solely the 40-day. That's just like a simple way to, kind of look at it. And sometimes he'll say, okay, the 40 is really 34, the left translation, right translation. It gets a little overwhelming at times. So what can the average person do to kind of protect themselves? They're listening. They're like, this kind of going over my head, this TA stuff.
Sure.
What are some simple rules of thumb to protect oneself from risk? Because a lot of people worried about, a big one like 08, was Silicon Valley Bank. And that's the thing, right? Is Silicon Valley Bank the countrywide moment, and then later on there will be a Lehman Bear Stearns moment? Nobody knows for sure. Or was that the 2015 moment, the 2002 moment, whatever it might be?
Right. So, I mentioned it earlier in terms of, where's the contagion? If SVB is the new countrywide, what's the Lehman, what's the Bear Stearns? Would you see that reflected in, earning? JP Morgan just had fantastic earnings. And this, again, I mentioned earlier, the stock it has a really bullish setup. Now, if that starts to become an issue, you'll see that reflected in price. But in terms of keeping it very, very simple, for your listeners and, something that you can protect yourself. One of the best sayings, I think, whether, you're a trader like me or a long-term investor, if the three most important things in real estate is location, 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 the three most important things in investing and trading is risk management, risk management, risk management. So understand where you're wrong and just get out. And if you got to sit in cash, we keep it at a bank or not underneath your bed, whatever it might be. Just always know where you're wrong and admit it. And then, and then there's always going to be another trade. So don't be afraid to, get out. Another thing that I'll say, and I say this to, friends, even subscribers, whoever it might be, who say, like, what's your number? Let's say for simplicity, you have $100,000 invested in the market. What's your number where you're like, I don't want to lose anymore? Is it 70? Is it 80? Is it, I'll risk 50%? What's the number where you're like, I can't take any more? Whatever that number is going to be different for a lot of people. Everyone has a different risk profile. Whatever that number is, stick by it. Okay. If it hits your stop, or, if your entire portfolio is down 30%, I can't take this anymore, then just get out. And then, wait to see what happens. You can always get back in, always. So I think those are the two biggest, simplest things that you can take away in terms of protecting yourself.
So where do you see opportunity right now? What sectors do you like? Do you like Russell? Do you like S&P 600? I don't know why, by the way, people go into Russell so much. I've done a lot of work that the S&P 600 is usually better than the Russell 2000. Is that
Yeah,
just
it tends to be micro caps, much smaller companies, and then the small caps also have a lot of exposure to the regional banks. And so you saw the IWM, which is the iShares Russell 2000 fund, drop with XLF, the financial sector, and then the KRE, the regional banks. So those have been underperforming for sure. Right now. I like industrials. I like the big banks, J.P. Morgan, especially. I still like tech, some tech, not all of tech. But again, I'm looking for this breakout, and
define tech like microchips, processors,
semiconductors
social
have been on a
media?
tear. Semiconductors have been on an absolute tear. Nvidia, just unbelievable with the AI chips. Even advanced micro devices. You look at Taiwan Semiconductor. You look at ASML in Europe. So they have just incredibly bullish setups. And you talk about higher highs, talk about higher lows. I mean, it's just beautiful trending market. And the bank fiasco in March didn't do anything to disrupt it. So I just don't think there's any contagion there. So you have to get confirmation first of this breakout. But once it happens, especially given so many people are bearish, I think that 2023 is going to be a really good year for investors.
Wow. So that's good news. Among the sea
Yep.
of bad news, we're getting good news from Greg Diamond. And Greg, are you an author of any books or just the newsletter for Stansberry?
No, just the newsletter now. I'll probably write a book. I don't know, maybe in 20 years when I actually have some time. But I have a busy job, and I just don't have the time to write a book. But I've thought about it. I mean, I could write a book specifically on my career on Wall Street, and then kind of the lessons that I've learned, and also how I use my trading analysis. So it's something that'll I'll have in the future, but not right now.
Do you like ETFs, individual issues, typically, or
You
doesn't
mean to
matter?
trade?
Yeah.
Sure. Yeah. I like to look for anything that has liquidity is going to be good in terms of open interest for the options that I use. So ETFs are a great way to do that for sure.
So you like banks. What would get you to not like banks?
Obviously, contagion. I mentioned it earlier that commercial real estate loan is going to issue, especially for regional banks. We saw a little bit of that last week. I live outside of DC, Northern Virginia. Brookfield, I believe, is the name of it. Defaulted on about $160 million. So and this is all based upon the new economy in terms of hybrid working from home and stuff like that. So are there more regional banks with that type of exposure that could hit the entire system? I don't know. And I think that's definitely a bearish catalyst that you need to look out for sure.
Yeah, risk of default in the commercial real estate market is growing as office and retail property valuations could drop by as much as 40%. Funny, that's not really happening where we are in New Jersey, but I'm sure it's happening elsewhere. I've heard stories of Texas where they just built so many office complexes, and retail property valuations could drop by as much as 40%, while nearly $1.5 trillion in debt is due for repayment by the end of 2025. Wouldn't that be, though, the problem in 2026?
Right. So, and that's something that I also think about, and you get into longer term cycles, which I won't really, but that all that debt that's starting to pile up in the next few years absolutely could be an issue later on, 2026, 2027, even 2028. So I think the big question is, how does the Federal Reserve, they have to be aware of all this stuff, although I'm not going to assume, because they weren't aware of it in 2008 and totally crap the bed, for lack of a better expression. But they have to understand, especially given what happened with SVB, which was in the actual bond market, not necessarily debt. But how are these regional banks exposed, and can the Fed do anything about it? Is this the reason that they're going to start pulling back on their monetary policy? That's definitely something to watch, over the next 6 to 12 months.
But why is that a risk? If I'm just think through with me here, I have, let's say a commercial real estate building that I refinanced in 2020 on a 5-year adjustable rate mortgage. Most commercials loans are like 5 or 10 years. They were epically low rates. So then they come due and you got to refinance in 2025 or 2026.
Mm-hmm.
My commercial building went from whatever, 2 million in real estate values to 3.5. And the banks would just foreclose if I can't pay and they get all that equity. So why is that a risk to the bank? I mean, it could be a risk to the broader, population because you have all these, but generally real estate's higher than it was in 2020. Even with things slowing this year, real estate is appreciated. So I don't see that being a big problem, but I do see a lot of people, namely, I call it like all those people online, like the Grant Cardone effect, teaching, you can be a millionaire in real estate, buy a $10 million apartment complex. So you have somebody doing that, and then those people can't pay their rents. They're not good property managers. I could see a contagion there, definitely. But then the banks would just foreclose on the properties.
Right.
Although I've heard bankers say you don't really want to do that. They don't ever make money. Even if they sell it, they usually sell it for a loss. So maybe that's why. It's just they're not in the business of property management.
No, you could be absolutely right. And again, I'm not going to speculate on what will happen in the commercial real estate market. It's just something to be aware of because obviously there's a changing dynamic in the economy in terms of people working from home and the demand for that real estate. So does it just go off the books and a few more banks fail and then that's it? Or the big banks or BlackRock, Blackstone, whatever it might be, they just scoop up all the distressed debt or just buy these buildings in cash and then who knows? I mean,
but that's my point. Like I'm just thinking of my own building. We refinanced 2020. Boom, real estate values were less. Now they're greater. Worst that happens is they take over the property, they sell the place, and they make money. So I don't.
Agreed. Yeah. No.
I mean, I think they're not generally really equipped to manage real estate portfolios as a bank. The other problem, I do think that will be a great opportunity for buyers of real estate in 2026 because I just think people will not be able to afford the new interest rates on their debt or to pay off their mortgages. So it'll be like 2008, but for the commercial space. But I'll tell you what, my bank, they made me like sign over my third child. I had to have like 50% equity in the property. I had to personally guarantee stuff. It was not, and it was a big bank. So I don't think they're,
You didn't get a ninja loan?
No, but I see, I don't think they do that anymore.
No. Oh, God.
Now, I do think they did that with some wealthier buyers in the commercial space, like apartment complexes, because I had heard ridiculous terms of like friends who bought, a $10 million apartment complex at, 4%. And then they use the rents to offset, but they're getting higher rents now. I mean,
right.
A 2-bedroom apartment in Freehold, New Jersey is $3,000 a month. And people are paying it. So even if they have to cut their rents in half to pay the debt service, it seems like inflation has so touched housing that even if housing corrects 20% or commercial corrects 20%, people get a 20% discount, they'll be thrilled. Their rent will go from $2,600 to $2,100. That's the thing. If people didn't buy a house 5 years ago, I don't know. Some theorists have, kind of said, hey, we're going to become a renter nation and have people just been left out of housing. So you like semiconductors, you like banks, any other sectors you like right now?
Yeah, I like industrials too. So, it's...
When you say industrials, what do you mean? Like
Caterpillar, Granger, Train Technologies, all have really good stocks. All, even if you're a dividend investor, they're going to pay a really good dividend too. That hasn't changed despite inflation. So these are just, long-term core holdings, but also something that I'm interested just over the next 6 to 12 months as a trade.
And folks, we're with Greg Diamond of the what's it called? The 10 stock trader.
You got it.
And Greg accurately predicted the 2022 download. 2022 downturn almost to the day. I mean, maybe you're like a week off. It was pretty good. Do you know what did you exactly, did you get a lot of press for that, or was it just Stansberry pumping you? Because I didn't see anybody like say, oh, this guy got it right. And it was maybe you and McClellan. You follow McClellan?
Tom McClellan?
Yeah.
Yeah.
You
sure.
and Tom.
I don't follow him. I just know, I know him based.
Tom was pretty right. Tom and Sher McClellan. You were right. But very few were, because that January 1st dip caught a lot of people by surprise. And, it's great that you did well there. What about sectors to avoid? What don't you like?
Well, on a relative basis, I think the regional banks are they're going through a transition, for lack of a better word. So there's definitely some risk there that I wouldn't get super bullish on. But the big banks I do like, J.P. Morgan, Goldman Sachs. So I would definitely say regional banks are one that I would kind of stay away from.
But aren't regional banks really big banks now? Like the Truists of the world, or I don't know, PNC. I mean, they're very big now.
No, agreed. They're definitely big. So it just I don't know what exposure they have. We found out really quickly through SVB that they couldn't even manage a bond portfolio, and that was the biggest thing, is they kept buying U.S. Treasuries thinking that the Fed wasn't going to keep raising rates, and not understanding that bonds go down when that happens, and they just blew up. It's pretty simple risk management.
Yeah, I don't understand why they didn't.
Bombed on.
I don't know why they didn't just buy short-term Treasuries or something.
I'm sure we'll get some. Well, hopefully we'll get some answers in terms
or even
of,
80% short-term Treasuries and 20% risk stuff. It was just strange.
Right.
So, other sectors you would avoid right now? Talk to banks. What else?
Let's see. This might stir people or upset the pot a little bit, but I'm very cautious on precious metal mining, gold, GDX, SILJ. Some of those gold and silver miners. I just don't like. So there's inflation, there's the dollar, and then there's war, Ukraine, Russia, right? And so gold and silver will trade based upon uncertainty and war, and then also inflation, and then relative to the dollar. I just don't like the way that precious metals are trading, or how mining stocks are trading relative to the underlying gold and silver rally. So I'm not completely sold on it yet, but it's not something that I'm just going to go out and drop the hammer on and short. Take a mortgage out of my house and short the whole market or that sector. But that's something that there's been a lot of bullish calls on it, and gold has rallied, above 2,000, but the silver not keeping up with it, and then the mining stocks diverging big time. As a technical analyst, that makes me very cautious.
Do you like gold and silver, not the miners?
Yeah, I particularly like gold, but that's I just have gold as a long-term investment. It's not something, I haven't really traded it this year. I don't think I traded it all, actually. And going back to last year, I traded it just a little bit. But if you held the gun to my head, I would own gold over silver or the miners.
Okay. Yeah, the gold cycles might be bearish now, but I don't.
It's just something I'm watching.
Yeah.
I don't have.
But do you use the cycles on gold or not really?
Yeah, I find gold to be a little tough. I think it's kind of lumped in there with interest rates in terms of modeling those cycles and understanding it, relative to stocks. Not that stocks are easier. It just seems to make more sense in terms of the history of cycles. And gold Gold's difficult. Gold's a tough one to forecast.
Wonderful. Well, we're with Greg Diamond, CMT, talking about his thoughts on the market. Anything that you wanted to share that didn't have time to share as we round out the interview?
I guess I think the only thing that I'll finalize or discuss with your listeners is there's so much bearishness out there that this is the kind of market that will hurt those bears and do the most damage to the most people. And if the most people are short, that is where we're going to rally. So again, I mentioned at the top of the show that that March 13th low, especially in the Nasdaq, is absolutely critical. As long as that holds, I do believe we're going to see a breakout, and we could see double-digit gains in the majority of indexes this year.
Wonderful. That's a great way to conclude. Greg Diamond, the 10 stock trader. Thank you for joining us. I was looking forward to having you on for a while. Greg Diamond, where can people find more about your work?
You can go to stansberryresearch.com. You can find me on Twitter, DiamondTrader10. And if you could call our office at Stansberry, or you just go to the website and look around and see what we have. It's not just me there. We have 25 other services and editors who all do a great job. So a lot of different services, not just trading options, but pretty much cover it all at Stansberry Research.
Fantastic. I want to thank you all for joining us, and thank you to Greg Diamond, CMT of Stansberry.
Thanks for having me on.
Thanks for joining us.